Is being a fiduciary enough? Is being a fiduciary enough, or do you need to offer more? And is AI everything, or are there other places to look in this market? All you've heard about for the last month and a half or 2 months is AI. It seems to be everywhere. Next, an ETF that offers 100% downside protection. Folks, you can't lose money. You can invest in the stock market and you can't lose money. Hell, we might as well just close up Revere and go home. We're done. This ETF can just invest and nobody can ever lose money. We'll talk about that. We'll talk about the pros and cons of that. And it really is taking a shot at the indexed annuities. BlackRock, I'm pretty sure it's BlackRock that offered it, is now trying to take a shot at the insurance companies because they got a lot of money. BlackRock wants it. We'll talk about that. And then the special rebalancing on the NASDAQ. I'm sure you felt that yesterday. Maybe that was part of it. Maybe it wasn't. Maybe it was just earnings. But they are going to rebalance the Magnificent Seven, the big seven NASDAQ heavyweights, QQQ, NASDAQ 100. They're actually doing it as we speak, but over the next couple of days, we'll kind of talk about that because there was no transparency. They didn't actually let everybody know how specifically they were going to do it. Okay. And then Tesla and Netflix and a few others took a big hit yesterday. What is our plan? What is Revere's plan? And that'll segue into the mailbag. We got a great question on Tesla early on in the week. So with that, we'll get right into it. So and by the way, all these articles or all these topics I'm talking about are in the show notes. You can go look at them. You can read them if you want. I've done some, I didn't put too many in there. I do some other research over and above just those articles, but those are just kind of the teaser things to kind of get you the premise. Now, so a lot of people are now questioning, because there are more and more people being fiduciaries now. So remember, the rise of being a fiduciary, fee-based only, and getting rid of the conflicts of interest, broker, insurance agent, surrender penalty, heavy commissions system, that kind of went away. Slowly over time, people are becoming more and more fee-based only, more and more advisors like us. I did it when you could first do it. I did it 25 years ago. And now there's a big push to do that. And so now, but when people were first doing it, all you had to do was say you were fiduciary and you brought in money. Because people liked the fact that there weren't conflicts of interest with a commission salesman. So first of all, I got to ask you, the listener, do you have a fee-based only fiduciary? If not, why not? Really? Seriously, why not? Why do you want to pay commissions and have surrender penalties and expensive things? Look, even in the insurance and annuity space, there's fee-only annuities and insurance where you don't pay a commission. There are no surrender penalties. You can put the money in one day and take it out the next. You don't hear about those because why? There's no big commissions. That's the whole point. So in any event, is being a fiduciary enough? I personally, I say absolutely not. No, a fiduciary is just how you get paid. Now, being paid free of conflicts of interest, so you're on the same side as the client instead of on opposite sides, is obviously better. I agree with that. However, if you're just going to do the pie chart, buy and hold, set it and forget it, or the pie chart with the rebalancing on some arbitrary date, end of the year, semi-annually, what have you, and you're just going to ride the market cycles, then you don't need an advisor. I could show you how to do that in 15 minutes. Hell, there are ETFs called target date funds that have the date that you're looking at retiring, and they kind of do those pie charts for you. So if you're just doing a passive investing strategy with just very little research, you could do that very inexpensively. Now, to do that, you will have to go through 25, 35% drawdowns every 4 or 5 years. That's just the deal. And they tell you the market always comes back. Just don't worry about it. And that's fine if you're an oak tree and you can live 400 years. But if you're a human, you've only got about 20, 30 years of aggressively saving and 20, 30 years of aggressively spending, retirement. So you really don't have that time frame. So for humans, it's really important as to when those cycles happen. And so maybe you do want to sell discipline, buy rules, managing drawdown risk. So At Revere, we constantly adjust risk. We're constantly managing risk. And so we're making adjustments on a daily basis. That's really what you pay active management for, in my opinion. And if you have a fiduciary advisor, ask them what their sell discipline is. Ask them what their rules are. Or are they just putting you in a pie chart based on your age and your station in life and your assets? So everybody that looks like you, if they're a wimp, they get a number 8 pie chart. If they're moderate, they get a 10. And if they're aggressive, they get a 14. If you're doing that, it doesn't matter if you're fiduciary or not. Even a commission guy, because you'll recoup those commissions over time. If you're holding it for the long term and you're just going to write market cycles, I don't think there's as much distinction. I don't think it matters. Anyway, that's food for thought. But if you don't have a fiduciary advisor, you need to ask yourself why not. Oftentimes it's a relative, it's a brother-in-law, and you can't help it. Because not getting divorced is more important than having a better investment strategy. I get it. But if you have a choice, if it's not your brother-in-law, there may be a better way. All right. Now, let's talk about AI. We're going to talk about the markets, but everybody has been focused on these big, they call them the Magnificent Seven, these stocks that have just rocketed up this year. And it was based on AI. It was NVIDIA, Microsoft, all these other companies. And they've gone up so much, and everybody's talking about that, but there's other pockets that are showing strength. And we're going to talk about that along with these the special rebalancing, because that's actually those two topics are kind of related, because the special rebalancing, what the NASDAQ, the NASDAQ 100 QQQ ETF, it's a huge, big ETF, and it has the NASDAQ 100 stocks. Well, these top 5 or 6 stocks represent over 50% of the QQQ exposure. So just 6 stocks are basically half the whole QQQ, the NASDAQ 100. Okay? They said, we don't like that. So they said any stock that's 5% or more position in QQQ, you add all those together. So if you got 6 stocks that represent more than a 5% position size, you add all those together. If that is over 50%, we got to trim those down, and we got to trim that down to where it's, I think, Don, 37.5 or 35, 30.
38.5.
38.5%. And so that's going to put some selling pressure on the NVIDIA, on the Microsoft, on those big Tesla, on those big companies. And so that's going to tie in with the news, mailbag. But very quickly before I hit that, I did put a list in the show notes about there's a website you can go to, and it's a list. And I cringe when I say this. Don's going to slap me. There is a list of fixed annuities in there that gives you a ranking of the highest paying fixed annuities. Now, for 10 years, fixed annuities have been worthless because the yields were at 0. They're not good. You couldn't get a, quote, safe fixed return. Now the fixed annuities are around 5-6%, and they're more palatable. I still don't like them. It's still it's income first and principal second when you take them out, so they're not tax efficient. And yes, I know there's a few rules that if you take it out over a series of scheduled payments, you can set it up so it's a pro rata income and return of principal. And so you can kind of you can fix that a little bit with certain annuities. But the whole point is most annuities, first of all, we don't do annuities. We don't like them. We don't think they're expensive and they're clumsy. But if you're going to do an indexed annuity or variable, please call me first. Don't. Now, if you're really, really looking for some kind of fixed income, those are kind of starting to come back in favor because the interest rates are higher. Anyway, enough said. If you ever want to talk about annuities, I'm very good at it. There's only very few circumstances where they should be used, in my opinion. They're way overused. All right, back to the heart of the show. So for a couple months now, we said the market has been getting better. It's been broad. Well, we said a couple months ago the market started rallying, and it was really those big Magnificent Seven we're talking about. Those stocks were really starting to heat up. right? But the rest of the market wasn't. There was not a lot of breadth. And just about a month ago, 3 weeks ago, the breadth started expanding pretty rapidly in mid cap and small cap, and other stocks started doing well. It wasn't just a magnificent seven. And that's when we came out and said, the train is leaving the station. Are you on board? It doesn't matter if you're scared. It doesn't matter what you think. And as long as you have a sell discipline, you can participate knowing that you may get stung, but you're not going to get creamed. You got a sell discipline, so you're limited on how much you're going to lose. Okay? But we said the train is leaving the station and you need to participate in some fashion. What that looks like, I don't know, but you need to do something. And that is what's happening. We've had this big, strong rally over the past month. And then yesterday, we had a pretty harsh sell-off. And it was precipitated by Tesla and by Netflix. And then you got a lot of contagion around the big tech bellwethers. So my question to the Revere team is, the train left the station and it started to go to its destination. Now is it time to get off? Should you get off the train or should you keep riding? In other words, does this uptrend that we've been having, is it sustainable? How will you know? What are you looking at? Or do you need to get defensive? So I'm going to read this mailbag letter because it's perfectly apropos. It fits right into the theme of this week's show. And that is, do you pause or do you keep staying the course and stay on the train? All right, this is last Monday. This is GJ. 717. Hi, guys. Little Tesla seems to be liked today as it's up $8 a share. Thanks for including me on options. Okay. Can you share how long you're planning on? Can you share how you're planning to handle earnings release after the market close on Wednesday? This is for Tesla. I know we should not predict, but James Ropel advises to make life-changing money, you have to invest in a true market leader. Then hold through 4 to 6 beat and raise quarters. My plan for my core holding. That's my plan for my core holdings. Last quarter, Tesla dropped from earnings from around 180 to a low of about 152, and now it's up almost 300, double in the past quarter. So now it sounds like he's kind of assuming that's going to repeat, and it might. So I am personally holding and fully invested with my cash. Any plans you can share on options around this earnings release? Thanks, GJ. This is Don's answer, 7/17, same day, Monday. Hi, GJ. I will discuss our risk management strategy for Tesla on earnings in tonight's video. So if you want to listen to how we were going to, well, Don's going to mention it here too, probably, but you can hear an in-depth thing if you go back to our market insights, daily insights on 7/17 on our website. Okay. Then my answer. With regard to the option strategies, we are looking for growth stocks poised to break out off a number of things. Bounce off the 200 simple moving average, 821 EMA cross, or other technical indicators along with the fundamentals so that probabilities of a short-term breakout are in favor. We do not look for options on Tesla specifically. He really loves Tesla. But when and if the setup arises, we take a position. We already have some calls on Tesla when you got an options approval, and I have added the January 2025 lead 400 strike to the larger account. But if larger account, because if Tesla disappoints, there's lots of time value on the option, so it won't get creamed like a regular option or meaning this year. So it's got a lot of time left. We cannot do in the smaller account because the option is too expensive. It would take far too much your portfolio size. Even for your larger account, Tesla option is 4% position on the outer limits of our option sizing. So folks, a couple of things in there because there's some gold nuggets. When you're using options, sizing is critical and crucial. You need to know the maximum loss and the maximum effect on the total portfolio. Picking the right option is important, okay? And for this one, Tesla had already kind of had a run and it was somewhat extended. We took an option further out, okay? But the main thing, forget so much about the options talk in this email. The main gist of it is he was emailing on Monday and Tuesday and Tesla and Nvidia and all those companies were rocking, doing great. He was excited. We were excited. Everything's going great. Then all of a sudden, yesterday came around, and they all took a hit. So here we are today, and I'm going to turn it over to Don and Team Revere, and we're going to talk about all those things. Don, go ahead.
Sure, great. So let's start with what our plan was for handling options. This is a spreadsheet grid that I use. It has different scenarios. This started with Monday, what our size in-house on Tesla was. Monday, it was 5.65% of the portfolio. And then I look at what is the expected move. It's called the Marketmaker move. We get this from our Thinkorswim platform on earnings. And on Monday, the expected move was $18.26. That's either a plus or a minus. It's not a guarantee in either direction, which is about a 6.38% move. Now, we've seen growth stocks that we own, worst case scenario, make a 2 times the expected move. And we are aggressively conservative when it comes to protecting the downside, in particular with earnings. Some people think you shouldn't even hold through earnings because it's a complete gamble. We don't believe that's the case. We want to be prudent about it, though. So the prudent metric that we've decided in-house is, in a worst case scenario, a 2% move to the downside on Tesla, we are going to cap our loss at 1% of the overall portfolio. And then we just back in to the size that we're permitted to have based on the price going in and the expected move. So by right before at Wednesday's close, right before Tesla, the price was at $292. The expected move was $20.20. The portfolio size was $575. 2 times the expected move would take the stock down to $251. And the maximum size that we could have if we got the 2% downside expected move and capped our loss at 1% of the portfolio, the maximum size we're allowed to have was 7.23%. Which was acceptable because our size going in was 5.75. So this is just these are just some edits built in to say, is the size okay? If it's not, then you need to reduce. Like, for example, if we had a 9% size, our maximum was 7.84%, we would have to reduce the size of the overall portfolio. So that was our plan going in. Now, as far as handling the position that we had, we've made 3 buys on Tesla over the course of this year. The first one, let me get to another tab on my spreadsheet here very quickly. So we first got into it at 290 at 190 and 196 on 523 and 526. So this was Tesla's prior earnings. It had a negative reaction to it. It took it 6 days for it to stop going down and put in a bottom, and then it started up the right side. They had a shareholder, they had an analyst meeting, and the stock started to act completely different after that analyst meeting. And this is where we took our position on this break above here, 526 and 523. It was a couple of days after, because we saw a change in character at the stock. We saw it get above the 50-day moving average. It was still above the 200, but volume was coming in and it looked like it stopped going down. The market was acting okay. So we took our first 2 buys in there. And then the third buy we did on 627 when it pulled back here near the 21-day moving average. So we're managing 3 separate cost bases on this. So at its high up around 300, we had about 50% gains on those first 2 buys and about significantly less on 627. So really, if our stops started to get hit, and we use the 21-day exponential moving average to handle a lot of our portfolio. With bigger gains, we give it down to the 50-day moving average very often. But when Tesla started to break below the 21 after earnings, We cut the gains on the 627 buy. We ended up with about an 8% gain on that. And that's just that just hit our tolerance. It was over a 20% gain. It shrunk to a 7.4% gain, and it broke a key area. So add all those things up, and we're looking at protecting the downside. We're not thinking about how much money we can make on the upside anymore. We'll give it more room for the buys that we have back here, but for newer clients coming in, holding something based on a legacy cost basis is not how we do things. Very actively managing the gains for new clients that came in all throughout this period here. And that's one of the critical value adds that we have for our clients. Is not everybody just gets the same sales price. We are conscious of what your cost basis is, and we don't want significant money to be lost, especially if you just brought your account over to us. So we did trim that when it broke the 21-day moving average. It looks like now the 21-day moving average is rolling over, and that was actually in sync with the high for today. So it appears as though that 21-day moving average is now flipping from support, which is where we bought it down here, to resistance. And until this is a change in character for Tesla. Until we can get back above that 21-day moving average, we're thinking more defense than offense on buying or adding to Tesla. Now, if it breaks today's low, we'll consider either selling some more or hedging. They have one of the good things about Tesla is it's very liquid, and it also has ETFs that you can use to hedge it directly. And this is especially for clients that have 40% gains. They don't want to pay taxes if they don't have to, but we can buy the equivalent of a downside. It's sort of like using options, but you get a one-to-one correspondence on it because you can buy TSLQ or TSLS. Those are ETFs, but they trade in sync with the stock. In other words, if Tesla's up 1% on the day, they're going to be down 1% on the day, and vice versa. So that's another way to hedge the downside while Tesla decides if it wants to form a full base, which in case it could come all the way down to the 50-day moving average, which is another 11% to the downside, or it could pause at a round number like 250 that acted as a support resistance area over here in June. Or it could go right back up after a couple of days. And if it does, we can recoup our position. We really like the stock. We really like the story. But we also liked the story over here last year when it peaked at 314 and over the last 3 months dropped to 102. We're just not in love with the story enough to lose 68% of our money because we think the story's good. The market price is the market price. It doesn't matter what the outlook of the company is. I mean, what really has changed with Tesla from September of last year? We've got closer to the Cybertruck production, a little closer to the semi-truck production. They've cut prices. They've raised prices to seek demand. They've added some other auto manufacturers to start using their charging station. That's going to develop some revenue for them. But for the most part, the story isn't significantly different than it was back in August and September when the stock was at 314 than it was back at the end of December and January when the stock was 100. So we always want to match our thesis in the stock to the price, and losing 68% of your money is just foolish, in my opinion. We'll wait for the price to match up with the story. That's what we did when it started acting better, and we got in here around 190, added to it on the way up around 240, and then now it's topped at 300. And until that changes, this is a good story that's in consolidation or pullback mode, and we're going to manage our risk accordingly.
All right. By the way, go ahead.
I'm sure you have some interpretations to do on.
Well, no, actually, that what you did. Actually, you did very well. I don't have anything to add except you were talking about the investment business, or the in a lot of like you were talking about individually managing those pieces based on new clients that came in, right? Identifying them. Folks, in most advisors, it's not the investment business, it's the changing of the investment business. Because if they're brokers, if they're not a fiduciary, they don't get paid unless they have you in their stuff. So when your account transfers in with all the stuff you have, they liquidate your entire account and then they go buy their stuff the very first day. Doesn't matter whether it's extended too high, too low, or whether it's timely or not. They just mirror everybody's portfolio that already exists in that strategy. Like Don was saying, we've got previous clients that had Tesla at a much lower cost basis and have a much bigger cushion and gains built in, right? And so, in any event, in the brokerage world, it's the changing of the investment business, and they just sell everything lock, stock, and barrel and put you in their stuff. At Revere, when you transfer in, first thing Don does is he looks at your stuff and says, dog, 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 sell, sell, sell. These two are actually acting right. I like these. Here's where the stop would be. Here I'm setting my alert. This one's good. And then here of our stocks we have, these two are extended. We're on profit watch. This one may not work out. It's close to our stop, so I'll wait. If it firms up again, they may get it. But for right now, they're not going to get it. These three are still within buy range. We'll get these three stocks. And then going forward, you get in with each new buy. So you'll get it assimilated. And it may take 2 or 3 weeks or a month, or may take 3 months. It depends on the market action, not us. So I'm sure you're used to the old places, Merrill Lynch, Raymond James, that actually will just liquidate your entire account the very first day and just buy all their stuff, because that's the way it is. One last thing I wanted to bring up, because you were talking about downside protection, and I kind of skimmed over that zero buffered ETF with zero downside risk, and I should have talked about that a little bit more. When, yes, you have zero downside risk, the problem is you cap your upside significantly. So it's a point-to-point 2-year thing with a cap of 15%. Divide that by 2, it's 0.7.5% maximum. So if the market does really, really well, if the market makes 30%, meaning 15% annualized 2 years in a row, you only get 7. You get 7. You only get that 15, not the 30. So those downside protection indexed ETFs and these buffered ETFs, they actually, because they cap your upside, that significantly reduces the overall return over the long term. People don't realize that. So it turns into like a 3, 4, 5% return. In fact, a lot of those things are structured to pay you that, even though it's not obvious. All right, Don, go ahead. Sorry.
Yeah, you want to flip to the market analysis real quick here now, Dan?
The
I'll go ahead and
market,
do that.
market analysis. Yeah.
Okay. So Dan talked about the big pullback yesterday in the NASDAQ 100 and growth leaders. So what we're focused on is the two big breakout areas that we've seen on the S&P and the NASDAQ. The first one was back on 6/2, where we broke above very clearly this consolidation level that we had. Went up, pulled back to the 21-day moving average, made another attempt to make new highs, didn't quite get there, pulled back again. But then on 7/12, we did break above again. And then now we're in the 2-step up, 1-step back, hopefully, scenario. So this shows the levels on the S&P 500. The NASDAQ 100 levels are significantly different. So here's the first breakout level there. Here's the second breakout level, but we're much closer to this pullback level on the NASDAQ 100. And you can see the relative strength heading lower with that big sell-off. It's not a changing character right now as long as this breakout holds. It was a pretty harsh move down over the last 2 days. We tried to rally this morning, and we're flat right now on the NASDAQ 100. So it is struggling a bit versus the S&P 500, and it's really not something that's unexpected. We've been pointing it out in our videos for weeks about how extended the NASDAQ 100 was versus its moving averages, and in particularly focus on the 50-day moving average, because once you get 6% over the 50-day moving average, that's historically extended, and you're always looking for the reversion to the mean. Now, we peaked back here at 11.6%. We got over 12% the next day over the S&P. We did one pullback and then another rally, another pullback. As of right now, that difference versus the 50-day moving average has shrunk all the way down to 5.5%, which is a lot more reasonable. And as long as we're still holding the breakout area and the 21-day moving average, they're kind of in sync there. which is at around the 372 area. So that's the key area that we're watching on the overall health and welfare of the NASDAQ 100. They've got the big rebalancing taking place over the weekend. That's going to shrink the percentages of the biggest 7 names in there. But what we've seen a lot over the last 3 days, this is day 3 on it, is money coming out of these tech names, but flowing into sectors like industrials, basic materials, staples, utilities, healthcare, real estate. And that's why the S&P 500 has been outperforming the NASDAQ 100, because if you've listened to any of my videos, you hear me say it all the time, all the rotation takes place within the S&P 500. This is a healthy rotation as opposed to money coming out of the market where you would see not only the NASDAQ 100 come down, but you'd see the S&P 500 coming down also. So rotation is healthy. Selling obviously is not healthy, but we're not seeing the selling. We're seeing a gentle pullback on the S&P. Haven't even broken the ADMA. We're still significantly above the breakout level, which is at the 21-day moving average, still another 2% above there. So good stuff there on the S&P 500. Not so good on the NASDAQ 100, but we're keeping an eye, as always, on the pullbacks. And if they get unreasonable, nothing really has seemed unreasonable yet at this point. It seems harsh, but when you go straight up for 7 or 8 days, a pullback in the opposite direction does seem harsh, especially if you miss the move to the upside and you're late getting in. But we've been reducing our exposure as we were overextended to the upside. Our beta got up, adjusted beta got up to about a 2.3. It's down to a 1.5 now. So we've taken off a third of our exposure, and we're looking to redeploy that when the pullback stops. We're watering the flowers and trimming the weeds, pulling the weeds, which means we're adding more money to our names that are working, and we're getting rid of the ones that are lagging, and always looking for the next big thing or emerging leaders. And you're going to see a lot of them as earnings starts taking place. You'll see some that are leaders fall by the wayside, like you saw with Netflix and Tesla at this point. Doesn't mean they can't change, but for now, the bloom is off the rose with those names, and you'll see names like that have gapped up on earnings that we'll be keeping an eye on. One in particular that we were watching was AEHR. It had a big, nice move up, but with the pullback in growth stocks, it's reclaimed a lot of that move, but just right to the ADMA, which is a natural area for it to pause. So this is something that's on our watch list as a possible buy as a future leader. And that's pretty much how we run things all day here. We're looking at what's holding up, looking at what's not, pulling the weeds, watering the flowers, watching the new money that came in to make sure that our cost basis is managed appropriately, and protecting the downside as always. That's always job number one.
Absolutely. We always say we manage risk first and the returns take care of themselves.
Right.
And by the way,
Right.
real quick, so both, I just want to clarify this for the listeners. Both on the NASDAQ and the S&P, if you look, we're making higher highs and higher lows. Is that an accurate statement?
That is an accurate statement. That's the pure definition of an uptrend, is higher highs and higher lows.
Thank you.
And until that changes, we're trend followers. We'll stick with the trend. When consolidations happen and they break out, that the breakout should occur in the direction of the prior trend. And if it doesn't, that's a change in character, and we take appropriate action to defend ourselves, because that's meant what was working prior has changed. So, and that's why we keep a big percentage in the SSO, because we catch all that rotation
S&P,
with a
yeah.
minimum S&P. Yeah, SSO is the 2 times S&P. We do that to maximize our
Cash.
capital
Yeah.
usage of our capital. Yeah, but so that's where we are right now.
All right. Well, let's hear from the team.
Michael, let's go to you first.
Okay. So this week I wanted to talk about. I've seen some news on Taiwan Semiconductor, and there was a Wall Street Journal article about it. And What they are, Taiwan Semi, if you haven't heard of them, they're the world's top contract chip maker, which means that they manufacture semiconductors according to the designs of other companies. So when companies like NVIDIA need chips produced, NVIDIA actually designs the chips, and then Taiwan Semi is the manufacturer of those chips. So they use the designs and then manufacture them in their factories. And the news was that they're delaying the start of new production of chips at their Arizona factory until 2025. So they've been building out this big factory in Arizona to bring some of that part of the supply chain of these chips back to the US. And it was meant to be in full scale production early 2024 or around 2024. And now they're postponing it until 2025. And what they're saying here, and what's interesting about it, is that they claim they can't find enough skilled workers in the US, and they may need to bring in experienced technicians temporarily from Taiwan. And that may be true. It is a little interesting. We have seen that there is a labor shortage in the US, unemployment's at record lows, and it is difficult to find highly skilled workers for certain jobs. So that I'm sure that is a factor. But part of it too, and this is just sort of speculation, it could have something to do with pressure from China. And the reason why I say this is because, as we all know, the US and China have worsening relations. That's been making headlines. It's no secret. And there have been several restrictions placed on exports of certain US chips to China. These really high tech, high quality chips, they've restricted those exports to China. And it is a national security issue for the US to reshore the supply chain, or not really reshore because we've never had this chip manufacturing capability that Taiwan has, but to bring that capability to the US, because we don't want to have this geopolitical uncertainty. If something were to happen with China, they were to make a move on Taiwan, blockade, do anything of that nature, it would really affect that industry for us. So just because we don't want to get into that type of situation, it is really important for national security to bring that manufacturing capability to the U.S.
Well,
And the
we already
fact
got
that
in we already got into it. Now we're trying to get out of it. Now we're trying to get not so dependent over there, right?
yeah,
Right.
exactly, yeah. Um, and something else worth noting is that while there has been surging demand from AI companies, there's been a serious slump in demand for chips in smartphones, cars, and different applications. The main usage for semiconductors at the moment isn't AI. It's all of these other applications. And as you can see, if you compare Texas Instruments or really any other semiconductor company, Microchip, MCHP to NVIDIA, you can see that divergence in performance. And Texas Instruments and these other companies in their earnings reports have mentioned that there's been a massive decrease in demand for a lot of their chips. And something worth noting is that the semiconductor industry is highly cyclical, and they sort of give us an overview of the health of the global economy. And demand has been weakest from China, as the expected recovery in that part of the world hasn't materialized. So we do have this hope and this move and this surging demand from AI, but currently these AI chips only account for 6% of Taiwan Semi's revenues, and they expect it to increase to 10% over the next few years, but it's still a relatively small percentage of their revenues. So something to keep an eye on is the health of the rest of the markets for semiconductors. And AI, it's still very early to tell what kind of impact that's going to have on the global economy. That could be the saving grace. It could revolutionize the world, but it is important to keep an eye on the rest of these semiconductors and how they're performing, because that gives the main use cases for semiconductors are still in these other applications, and And we need to sort of look at that because, as I said, it's highly cyclical. And the last point I want to make is that I think that's it, actually. So yeah, keep an eye on China. I saw an article as well that Kathy Wood. We mentioned a few weeks ago that a lot of firms are exiting China, a lot of investment firms, and Kathy Wood has officially, it looks like officially, completely exited China. So tensions could continue to rise, and that's really, yeah, geopolitical issues could cause a lot of disruptions.
All right, thanks, Mike. Appreciate that. Good insight. I thought the key takeaway for me when I first read the headline with TSM was like, they're lowering guidance. How could they lower guidance when they're basically in the industry that everybody is pointing as a need? But when they break down the fact that they make all these different kind of chips for all these different kind of purposes, and those purposes outside of AI were slowing down, and they're not going to commit full bore to AI because they don't know for sure if that increased demand for those chips is going to continue. So they're trying to toe the line and maximizing their productivity, just like every other company is. Thanks a lot, Mike. Let's move on to Connor, and he's got an interesting chart that we're going to take a look at, and then we'll go to Ted, who's got 9 interesting charts for us to take a look at.
Yeah, so this week I wanted to talk about some rotation that we're seeing. And the first chart I wanted to show, this is the ratio of the Dow Jones to the QQQ, the NASDAQ. So it's no secret that tech's been hot this year and it's been outperforming everything else. But when you looked at the ratio between the Dow Jones and the Qs, it was getting pretty low. And what we've seen this week is the Dow Jones has the last 2 to 3 days, it's been outperforming the NASDAQ, the S&P, and that's partly due to some weak earnings reactions from Netflix and Tesla. But when you look at this, given how low it got, one could start to think that maybe some of these Dow Jones laggard stocks start getting some money flow, and this ratio just cleared the 21 EMA. And so what I want to go into about that is, how can you find rotation? How can you see it sometimes before it happens? So, Don, if you want to just pull up a chart of the Dow DIA on MarketSmith. So the Dow broke out this week. It's a slower mover. It was setting up and it broke out this week. But if you look at the relative strength line, it's clearly been underperforming. But it is character change to see that get through the 21 EMA. But last week, a lot of stocks from the Dow were starting to make moves, find some buyers before the Dow broke out. So if you pull up UNH, this is a big Dow Jones component, and it gapped down heavy on earnings, super negative reaction, but then it got bought up right away. And you can see it gap down to that 445 area. And then within 3 days, it was already back up to 500 above the 200-day moving average. So that was kind of your first sign that, hey, okay, maybe people are seeing value in these names as they've taken a hit for a while and have massively underperformed. And then there's, if you go to MCD, this is McDonald's. This is another Dow Jones component, slower mover, more of a defensive name. But this one's been, it had that huge run up from 260 to about 300. It pulled back, and then now it's almost trying to form a secondary cup and handle as well. So this is another name in the Dow that's, it's not giving a lot of alpha, but you can read between the lines when you see some of these names starting to set up. And then, Don, if you want to go to Home Depot, this is another one that I was seeing. This is a Dow component as well. And like I said, this one's trying to break out of a cup and handle. And one common thing theme we're seeing is a lot of the relative strength lines for these names are getting back above the 21 EMA. So that's definitely a bullish sign for these names. But kind of the moral of the story for me, and when you see this, is that, you know, when we're screening every day and we're seeing stocks, more times than not, the stocks are going to lead you to the sector. So when you would have seen these defensive names starting to get a bid, some of the Dow names, that could lead you to reason that maybe tech cools off and some of these names see some money flow. But nevertheless, it'll be interesting to watch if this rotation continues, because all year there's been a couple days of rotation out at tech, and then it's right back into it. So that's something we're watching out for to help us get a better idea on market direction.
Good stuff, Connor. I want to point out, I've been talking a lot in the videos about how terrible the relative strength line has been for the Dow, and we're looking for a change in character on that. And we recently added this 21-day exponential moving average. It was a fairly new feature in MarketSmith, but pretty much in line with the chart that you showed, how the ratio just got back above the 21, the relative strength line did also. And that corresponded very nicely with the breakout of the base there. So another tool in the toolbox, the relative strength moving average line. Combine that with price to confirm, not guess, but to actually have a data-driven decision point. So appreciate that, Connor. Last but not least, we're going to go to Teddy Bull, who's got a bunch of charts to show us. So Ted, you want to start off here with, let's see, this is it the AD line, right, from the S&P?
Yep. So going off what Dan and Don discussed about healthy sector rotation and breadth improving, I'm here to provide some evidence that that is the case with these following charts. This first one Don has up is the weekly chart of the S&P 500. Above it is the S&P 500 advanced decline line and the New York Stock Exchange advanced decline line. As you can see, just like last week, we continue to make new highs in the S&P 500 advanced decline line. And then the New York Stock Exchange advanced decline line, we continue just to trend higher. So that just shows that stocks are participating, and that is what we want to see in an uptrend, not just the Magnificent Seven holding up the markets like the first half of this year. This one is the NASDAQ 100 weekly chart, and then its advanced decline line. This is still pinned at the lows, but as you can see, it's starting to turn up a little bit, making making a higher high recently. But we would like to see this definitely come up more. So we see a weekly reversal candle now, so maybe we can get some digestion and then see more stocks participate and then hold up the markets. So next, we have the net highs and lows for the New York Stock Exchange and the NASDAQ. This is the New York Stock Exchange net highs and lows. As you can see in this last period, we've had the greatest persistent net highs we've seen in the last 1.5 to 2 years, surpassing that February area. And so that is good to see, and we would like to see this continue improving. Even better, we would want to see one day where we get outstanding net highs, like 500 plus explosive action. That would really cement that more and more stocks are making new highs and participating. And then the NASDAQ one, the NASDAQ that Don had up also had the highest net high readings of this entire bear market and bear to bull transition. So that's also good to see. Now on the screen is the McKellen Summation Index, and which is also known as the NASI. And as you can see, even with Tesla and Netflix reacting poorly to earnings, we still remain in the overbought territory, and pretty much pretty much the line is pointed at the 1 o'clock direction. So that nothing to fear or to be worried about quite yet. So further, Don is going to pull up the S&P 500 weekly chart and its corresponding readings for the percent of stocks above various key moving averages. The top one is the 50-day, the middle one is the 150-day, and the bottom chart is the 200-day. As you can see, just again, like advanced decline line, the net highs and lows. This is just more evidence that stocks are participating, stocks are trending above their key moving averages, which is exactly what we want to see. And then same with the NASDAQ, which is slightly weaker than the S&P 500, but we're nearing that 50% level above the 200-day moving average, which is what we'd really want to see happen. So just monitor these charts in the next coming weeks and see if we can get continued breadth expansion. Going on, I want to talk about sentiment a little bit. So traditionally, based off seasonality, we usually have a strong first half of July, and then we kind of take a break starting mid-July and then into September, and then finish the year off on a strong note. So fear and greed has been pegged at this extreme greed above 80 level. So definitely frothy sentiment levels, and maybe we get now a month and a half or a month digestion to cool down sentiment. Maybe bears come out of their caves a little bit, and that could fuel a year-end rally. And then finally, one more chart after this one. We have the AAI sentiment. You see that in the last 4 weeks, we've been above historical averages, and last week we hit the highest bullish rating, above 50%. I don't think I've seen that before, at least in the last two years. So that is definitely something to note, and maybe we need to cool down a little bit. That doesn't mean we just completely fail here and the rally's done, but maybe just like some digestion, which would definitely be healthy. And then finally, I think, Don, there's one more image that I sent separately. It's the NAM reading. Yeah, it's still on the same email.
Gotcha.
And basically here, this just kind of shows like what money managers are doing, like whether they're deploying capital or withdrawing it to cash. And we've seen some pretty frothy levels here as well, almost hitting 100 in this last reading. So just continued evidence that we might be getting a little overheated in the short term, but this is good that money managers are definitely deploying their capital now. So that is the end of breadth and sentiment for this week.
All right, Ted, thanks a lot. And Dan, I think that wraps it up from the technical side, so you can bring us on home.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. They can hit subscribe, put in their name and email address. We won't reach out to them or spam them in any way. It's up for them to reach out to us and ask a question or want a complimentary portfolio review, or if they just want a topic to discuss on the show. And so, you can reach out to any of us. You can email me, Dan at revereasset.com, or Don, Mike, Ted, or Connor at revereasset.com. And you can always call us old school at 855 Real Wealth. We'll talk to you next week on Your Money.
Because it's not how much you make in the markets, it's how much of that you can keep.